We're headed for a crisis. The stock market is never commits suicide, but it can be murdered. What's the scenario that could cause a monetary crisis due to excessive debt load? And the answer is nobody wants to buy treasuries anymore, and they have to raise rates dramatically. We've entered an era of permanent inflation. I've been hearing these wild statements that gold is going 6,000. I heard the other day it's going to go up to 17,000. Well, if it's a 17,000, folks, we're in crisis mode. The world is in big trouble if gold is at 17,000.
There's a saying during a gold rush, buy shovels. So what is the equivalent today?
Well, certainly.
I'm pleased to welcome back to the show Mark Skousen. He's a macroeconomist strategist at the Oxford Club, the editor of the Skousen Report, and the author of the new book, The Greatest American, which is about Ben Franklin. I've been told, by the way, you told me offline that you're a direct descendant of Ben Franklin, Mark. So this all makes sense
great.
now.
Yeah, sixth generation direct descendant. So I'm a little bit prejudiced with my book title, The Greatest American, but it does turn out that Ben Franklin had 22 careers. He was a jack of all trades and a master of most. So I don't think anybody can really compare to him, considering all the 500 million Americans who have lived in lifetime. I put Franklin right up there. And so the book has done well. The Greatest American was a bestseller on Amazon, and I think subscribers, your listeners, would enjoy that book. It's not a typical biography. It's how to apply Franklin's life as a printer, as a publisher, as a diplomat, as an economist, as an investment advisor. He's a pretty interesting character.
Yeah. You know what? Let's start there. If Benjamin Franklin were alive today, or maybe he were transported forward in time into today's America, what do you think he would say?
Well, firstly, he actually said he wished he had been born 200 to 300 years later because he would witness the tremendous increase in our standard of living, the technologies. He'd be the first one to be using a cell phone and into AI and all of this kind of stuff. He would be fascinated, and especially communications and travel, jet setting, the internet. He would be in his own element for sure. At the same time, he would be quite surprised and depressed by the level of national debt. He was always a believer in living within your means. He said it was always an important part of life to, as far as government is concerned, to pay off the national debt. He's a firm believer in the saver. A penny saved is a penny earned. To live within your means, but to invest in the future of America. And he was very much an optimist, so he would love the optimism. The American dream, which he helped create, is still alive and well. So he'd have mixed feelings about the size and scope of government. One of the quotes from the Franklin book, The Greatest American, is from Franklin, who said, "The system of America is commerce with all and war with none. And if we do that, we can achieve unlimited success, the greatest empire in the world." And of course, both are being challenged today with the tariffs under President Trump and the war in the Middle East and Ukraine and so forth is not a positive aspect of our country.
According to many economists on my show, and actually surveys as well, the average American is most concerned today about inflation and the cost of living. This wasn't really the case 2 decades ago, or not even 2 decades ago, a decade and a half ago, right after the great financial crisis happened. We had relatively stable price inflation, as you recall. And so people were more concerned about, losing their jobs, or perhaps another repeat of 2008. It wasn't until close to COVID that we had huge spikes in prices all of a sudden. And now people are concerned about whether or not their wages will keep up with the rising prices. Was this the case 200 years ago? Did we have episodes of persistently high inflation such that the erosion of wealth was the primary concern?
Well, certainly during the American Revolution. In fact, during all wars are inflationary. War is the health of the state. And you do get inflation in every war. But up until World War II, inflation came back down and our standard of living grew tremendously. Our standard of living continues to increase, but we've entered an era of permanent inflation since World War II. And I sent you a chart on that, so I don't know if you can show it or not, but it demonstrates that inflation went up and down up until World War II due to wars. But then after World War II, for a variety of reasons, going off the gold standard, the Federal Reserve becoming activist. Yeah, look at this chart. This was done by Reinhardt and Rogoff at Harvard University, and demonstrates basically after World War II, we've had these hockey stick, dramatic rise in inflation. And even today, the Federal Reserve has a policy of inflation. 2% inflation is a year, and they don't even wait for inflation to come down to 2% before cutting rates. So we're entering an era of permanent inflation since World War II. It's not going away. The affordability crisis is the one issue that I think will derail the Republican Trump MAGA movement in November, where they will be on their heels and they will lose control of the House, mainly because the Federal Reserve has been too active in printing money since 2020, since the pandemic. Money supply increased 40% in 2021, 2022. And so we've come back down now to 3 or 4% rate, but we're still not down to price stability, which is what the Fed mandate is supposed to be. But instead, they've chosen a 2% rate. And really, it's 3 to 4%. And we've seen over and over again the persistence of inflation. Once inflation gets going, it's really hard to stop. So I tell all my investors, and I'll tell all your listeners, you need to make 10% increase in your earnings, in your wages, in your salaries, and your investments, just to keep up with the rising cost of living.
Before we continue with the video, let's talk about a problem that comes with owning gold. Now, gold has long been treated as a store of value, but the catch is that sitting in a vault, it doesn't pay you anything. So that's where today's sponsor, Monetary Metals, comes in. They offer investors a way to earn a yield on gold paid in physical gold. Through their leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces rather than dollars. So your holdings are measured in gold itself, not in fiat currency terms. The gold stays your asset throughout, and it can be redeemed at any time. Thousands of investors are already earning a monthly yield in gold through Monetary Metals. So visit the link down below, monetary-metals.com/Lynn, or scan the QR code here on screen to learn more and get started today. Was this a result of this hockey stick chart here? This 45-degree blue line, was that a result of Bretton Woods? Sorry, not the Bretton Woods, but the end of the gold standard in 1971, do you think?
Well, the two authors from Harvard say of all the in fact, I asked my students at Chapman University and at the Oxford Club, my subscribers, I say, so what is the cause of this hockey stick? Because it didn't happen prior to World War II. And the answer is there are a whole bunch of factors all working in favor of inflation since World War II. One is never-ending wars. We've had 5 or 6 of them. Another is creation of the Federal Reserve, which is the engine of inflation. Going off the gold standard twice in 1933 and 1977. And in fact, you'll look on the chart, 1971, when we went off the gold standard completely, you see an acceleration in the inflation rate. We kind of lost that discipline. Also, Keynesian economics, the adoption of Keynesian economics, which says when there's a threat of a recession, a downturn, you run a deficit, and we're running deficits even today. And then last but not least, the Bretton Woods Agreement, 1944, which made the fiat U.S. dollar the world's currency. It was backed by gold initially, but no longer. So we're at sea without rudder in that respect. And the only thing that's keeping inflation from excessive growth is that we return to normalcy. The Fed is adopting a more fight inflation policy, and the stock and bond markets hate inflation. They are the only discipline that we have left to keep things in a reasonable level of inflation. But if you think inflation is over, think again. It's just not happening in our lifetime.
Yeah, CPI has been down, by the way, for I think 2 consecutive months. This morning's
Not
PPI
down,
numbers.
not actually down. You're just saying the rate has declined.
That's right. The rate, yeah,
but it's still
the inflation rate.
Right. Prices are still rising. They're just not rising quite as fast.
That's right. So take a look at this chart here from the BLS. 12-month change in prices. We peaked around May, in May, 4.2%, and now it's at 3.4%. So the inflation rate has been coming down. Are you looking at this and saying to yourself, well, that was a one-off. Inflation, the spike in inflation was a one-off because of the Iran war, and perhaps we're going to get a normalization of the inflation rate following what happened earlier this year. Is that what's happening, or do you think this is only the beginning of higher inflation here?
Well, no, the Federal Reserve has come back down to a sane policy, and Kevin Warsh, the new Fed chairman, is fighting inflation. At least his rhetoric is very strongly anti-inflation, kind of a Paul Volcker kind of attitude. But again, he's accepted the 2% inflation rate to bring that down, not to zero, not to real price stability. By the way, The Economist just recently came out with a survey. It's called the Hamburger Survey or the Barbecue Survey, the Barbecue Index. And they basically say on a July 4th event where you have hamburgers, chips, and a drink, for 4 people will cost $81. That's a 12% increase from last year. So I'm not sure I really buy into the CPI index. I think the direction of the index is very important, but I think as an index, as the cost of living, it's rather defective and underestimates what the cost of living is. And when you spend time in the grocery store and at the gas pump, you realize inflation is a very serious problem and it's going to derail the Republican control of Congress and the White House, perhaps. In the midterm. So this has an effect by allowing inflation to get out of hand, even though it's coming down. It's not coming down fast enough. It's very stubborn. It's a stubborn inflation. Fortunately, the economy is doing better with that inflation. I'm very bullish on Wall Street. The technology sector is still very much alive, and it's an exciting era. I call this the golden era of the roaring 20s. It's another 100 years later, the roaring 20s in technology. That's what's saving us.
What followed the 20s was a Great Depression. Hopefully we don't get that. Is that any signs that this is going to be a repeat of the 20s and 30s from the last century?
Well, we have learned some history from the 1930s, but yes, I think the 1920s is the 2020s is a replay of the 1920s, the Roaring 20s, and there are charts that show that the Nasdaq is moving in the same pattern like it was in the 1990s, and we're halfway there. And in fact, in 1995. When Alan Greenspan talked about the stock market being at a level of irrational exuberance, I said the Nasdaq would double and then double again, and it did. And I think that potential is still there with what is happening with AI, with space technology, with the drones and defense spending. There's all kinds of examples where we are just booming in terms of new technologies and stocks that are doubling and tripling in a year or two. It's a very exciting era, and I think we're only halfway there. And yes, at the end, it's probably going to be a pretty big bubble when it's all through, and we could get similar to the 2003 era where the Nasdaq fell 70%. Did you know that? 70% after the dot-com boom. So we could see that kind of a fallout again once this golden era of technology has kind of reached a plateau, but I don't think we're there yet.
In this roaring 20s scenario, why is it that inflation is going to stay persistent? And I think more importantly, when you say inflation is going to stay persistent, what kind of inflation rate are we talking about? Is because 2% is the Fed's target? Are you referring to 2 to 5%, above 5%? What is the rate that we're looking at here that worries you?
Well, one thing that I think is really helpful is that Kevin Warsh is to quite an extent a supply sider and a monetarist, bringing back. Jay Powell decided not to look at the money supply at all. They didn't consider it in the Fed meetings. That's changed under Warsh. Warsh, I think, is a much better candidate to fight inflation. And so if he can push the inflation rate down to 2% and keep it down, then and if he can keep the price of gold down and silver, which are now rallying again, the threat is very real that inflation is here to stay. But it's all based on Fed policy and to some extent the pressure from the Trump administration of running these huge deficits, and defense spending, war spending is really out of hand. And this war is lasting much longer than expected. And the tariff didn't help, which is raising prices. So there's a lot of still strong inflationary pressure in the system. I don't think it's going up beyond 3 or 4% because you have Warsh, who's now a semi-monetarist. I think you'll see the money supply. Maybe he'll bring the money supply growth rate down to that 2 to 3 for maybe 4 or 5% at the most. That's encouraging. That's encouraging. So the jury is still out as to whether inflation can be brought down to reasonable 2% level. But the price of gold going up, this is the critical factor on inflation long term, is where's the price of gold going? And it's right near its 200-day moving average. So if it goes above that, it's probably going to keep going up for a while. Although I don't really buy into this idea. I've been hearing these wild statements that gold is going back. It's going to go up to 6,000. I heard the other day it's going to go up to 17,000. Well, if it's a 17,000, folks, we're in crisis mode. Our country is in Canada, United States. The world is in big trouble if gold is at 17,000 and silver is at $200 an ounce. I don't think
hear
that's
what you're
going to
saying.
happen.
I hear what you're saying, Mark, but let me just point out that when I first started interviewing several years ago, gold was still around $1,500, $1,700, and people were telling me if gold goes to $5,000, we're in crisis mode. Your theory makes sense. However, that was just a narrative a few years ago, and it doesn't look like you said, the economy is okay. It doesn't look like we're in crisis mode yet. Was there a reason why gold went from 1,500, 1,700 to 5,000 in a span of a couple years without the world needing to implode, Mark?
Well, that's a good point. And I actually predicted $5,000 gold, although it went up to 5,600. But I did predict last year it would go to 5,000. But then I thought, look, let's go back to 1980. When inflation was raging and gold went up to $800 an ounce very briefly, and then it collapsed and went into a 20-year bear market. Why did it go into a 20-year bear market? Because of Fed policy under Paul Volcker imposed a tight money policy and raised interest rates sharply. If we do that again, gold could go down and stay down for quite some time. They haven't done it yet. The Fed has not raised interest rates yet. The bond market is saying they should raise rates because the bond market is the 30-year bond rate is at over 5% now. So that does indicate a effort by part of the Fed. But gold overshoots, just like the stock market overshoots from time to time. And that's what happened without a total crisis. But remember, you had 40% monetary inflation in 2020, 21, And that caused the rise in inflation. Inflation didn't go too high because the United States is the world's currency, so we can export a lot of our monetary inflation. That's what we've done over the years. So, but really seriously, $17,000 gold, that's got to be a crisis type of situation, especially in today's environment.
How does someone's lifestyle change if inflation is, let's say, persistently at 4 to 5% versus persistently at 1 to 2%, which is what we had about a decade ago?
Well, you have to have inflation indexing as much as possible with your wages and salaries. I think it does put pressure on unions to force higher wages and maybe cause strikes and that sort of thing to occur, which used to be quite prevalent in the 70s and 80s. Not so much today, but that's certainly a way of compensating in that respect. And again, you have to be investing. You have to take greater risk in order to make that beat inflation, beat the market, try to outperform the market. That always requires greater risk. And that's what you have to do as an investor. That's what you have to do as a retiree. I mean, the Social Security is going up 3, maybe 4% in the next year. That's not enough to keep up with real inflation. Real inflation is much worse than that. The CPI does not include most taxes. It includes sales tax, but not income tax, not capital gains tax, not estate taxes, that sort of thing. So it's not an actual accurate measure of people's standard of living. But yeah, you just basically have to take greater risks, and that's hard to do. And especially in today's world where people are afraid to quit their job and start a new job or even find a new job. I feel bad for my seniors at Chapman University because they're struggling to find a job in today's world where AI is making it reluctant, and also the tariff, the trade war is causing a lot of companies to hold off hiring new people. So it is a real challenge in today's world for sure.
Your investment, you said, look, we got to prepare for higher inflation, persistently higher inflation. How should an investor change his thesis during a 5% inflationary environment versus a 2% inflationary environment, or even higher than 5%?
Well, I'm not actually saying that we're headed for higher inflation. All I'm saying is inflation, rising prices are permanent across the board. There are always some exceptions. Technology does lower prices on many new products, goods, and services. There's no question about that. But I do think that the key here is that you need to understand you have to stay ahead of the game. You can't afford to be wiped out on your 401k plan and what have you. You don't want to. You got to be diversified. So I'm a big believer in diversification. And my diversified portfolio has rising dividend stocks. I've mentioned before, Main Street Capital, symbol MAIN, MAIN, is one of my favorite income stocks. In fact, it's the only stock in the entire universe that pays a monthly and a quarterly dividend. So people ought to check that out. I like the energy stocks like Enterprise Products and the Williams companies. Those are good. And I'm a big believer in the technology. We're only halfway there. So invest in XLK. That's the technology fund ETF, the most successful ETF, most popular ETF out there. XLK is the symbol. There's a lot of really good portfolios that you can really stay ahead of the market. Yeah, this is XLK. Yeah, it's not bad. It's a pretty good chart. And right now it's kind of floundering up and down and so forth, but it looks like it could take off again, which I think it will do at some point.
You're not, you were, your first claim to fame was correctly calling the 1987 crash. And you had been warning your subscribers for many months leading up to that event. Of course, I don't think you knew the exact date and time, but I think you were warning that the signs were building up and it was going to happen quite soon. Now, can you just help us jot our memory here? What signs did you see back in early 87.
Yeah, so there was a lot of complacency, and there was also a book out there saying how anybody can be a stockbroker and make $100,000 a year. That was a best-selling book, and mutual funds were being promoted right and left. And it was also the beginning of computer trading. And I think that played a role in the stock market crash of October 19th, 1987, which turned out to be my birthday, by the way. So I'm kind of the crash baby. But I still remember it falling over 22% in one day. And that's never been repeated and never has occurred earlier. It's only that one day experience. And I think for two reasons. The two reasons we can have bear markets, but we're not going to have a 22% crash in one day. The most we've ever had is a 5% crash in 2008, October, November type of period. So, but you have the federal government intervening. You've got this group that gathers together and will intervene into the marketplace to keep that from happening. This was a committee that was created after the 1987 crash under President Reagan, and that's still in existence. So that's a possibility. Plus, you have stopgap measures where the markets will stop trading if the market drops a certain percent. So you have two factors at work there that will slow down and keep a crash from occurring. You can't stop a bear market, and a bear market can't occur at any time. We saw a mini bear market in July, but that was just a drop in the bucket compared to crashes that we've had in the past. But bear markets of 50% or more are still very much a possibility. I mean, even gold stocks can go through those kinds of periods as well. So they're buying opportunities. I mean, these bear markets that occur, those are opportunities to be a buyer, not a seller, because the long-term upward trend is still very much intact. The new golden age of technology is very real, and you need to get on board during these periods when the market is temporarily in a correction.
So the July correction that brought the XLK down 16%, and also the semiconductors, the SMH index was down about 23% in July. Was that the correction where the AI bubble pop that people have been talking about for months and months on end? Mark, did we just have that?
No, that's not a serious bear market. It didn't even fall 20%. You need a 20% for a definition of a true bear market or a serious correction. So I think that was a minor correction. Okay. Don't think it was really that serious. And it's clearly bottomed out and starting to move higher again. And in August, which is normally a really quiet time period where the market doesn't really do much. So we'll see what happens in September and October. Of course, crashes are famous for occurring in October. So we may see something like that. But again, I don't see. I think we're halfway through this bull market, and it could last until 2029, 2030, I think is a real possibility. And then there's some kind of a correction that will need to take place because you have the Austrian theory of the business cycle is really important here. The Mises-Hayek view that easy money, and we had easy money for a number of years here due to the pandemic, where Fed cut rates really low, and that created this speculative bubble. But what you're seeing is like the parable of the wheat and the tares. You have the wheat, which is the legitimate technology that is benefiting the world and making dramatic changes. That's the wheat. And the tares, that's the fake money, that's the fiat money, that's the easy money policy that is causing these AI stocks to be overvalued. Look, I've said for some time that technology stocks can fall in half and still be overvalued. But we haven't reached that point. What will do it? What caused the stock market crash to occur in 2007, 2008? Was the Fed started making up for its easy money policies by dramatically raising rates to really high levels. And that caused the stock market to crash. And by the way, they did it in 1999 also. It's one reason the dot-com bubble popped was because the Fed raised aggressively interest rates during 1999, late 1999, and it finally had its effect. And it had a snowball effect. So I think you'll have the same kind of situation sometime after this bull market ends. Nobody knows when it's going to end. But when it does end, it is going to be rather brutal, like the NASDAQ falling 70% from 2000 to 2003. And the market really, the economy really wasn't that bad during that time period. I mean, you did have 9/11 S&P, and so forth, and you had war and stuff like that. But the GDP, you didn't really have much of a recession at all until 2008, 2009.
I'd just like to point out that the pattern for the S&P is a doubling every 4 years, and that's I'm just looking at the chart. Between 2022, not even 4 years, it's doubled. From if you want to take the endpoint as 2022, then you have to go back to 2018. Let's do 2017. From 2017 to 2021, that doubled. And then from 2012 to 2017, that doubled as well. Every 4 years for the last 12 years, the S&P 500 has doubled from the previous 4-year cycle.
This chart does seem to show a little bit of hyperbolic move in the market, which is a little bit scary. There's no question about that. But go back to look at the 1990s. 1990s, it's kind of hard to tell there, but look at that. There's a very similar pattern there. Very similar pattern. But again, I think it's only halfway there.
1990 to 94, only up 50%. And then that's 95, that was a dot-com bubble burst, yeah.
And that was when, 1995 is when Alan Greenspan talked about irrational exuberance. Even then, he thought it was overvalued. And if people sold, they missed out on a huge opportunity. So I'm staying with it, looking for any indication that the market has topped out. I don't think that July, I never felt that was really, Humphrey Neal said it well. He's the father of contrary investing. He says the public is right during the trend, but wrong at both ends. But it's just really hard to know what the two ends are. That's a quote from my book, The Maxims of Wall Street, which, by the way, has now sold over 100,000 copies. Maxims of Wall Street. So it's definitely a long-term bestseller.
Yeah, Mark, two observations I have. The first is that if you look at this chart, the S&P has only corrected by the order of 50% during crises or external shocks. But on its own, the market isn't just going to correct more than 20%, even if investors think it's overvalued. So my theory is this, and I want to get you to evaluate this, please. We're never going to get another 40 to 50% correction or more unless there is a major financial crisis or not even a recession. I mean, there was technically a recession in 2022. It went down 30%, sure, but that wasn't on the scale of 2008 or where the dot-com bubble burst. COVID was another example. So unless we have some sort of global shutdown or global financial crisis or an external shock that would really move aggregate demand down significantly, the S&P or the market overall is not going to correct significantly more than 20% beyond a bear market, the minimum threshold for a bear market. What do you think?
Well, I'll give you another quote from Wall Street. Stock market is never commits suicide, but it can be murdered. And the murder can take place by these crises that you mentioned. It can be a fiscal crisis. We certainly look. Uh, we have 30, we're approaching $40 trillion on our national debt in the United States. Uh, Treasury has to refinance $7 trillion every year, and that's going up. The interest on the national debt is now exceeding the defense spending in the United States. We're headed for a crisis. So what's the scenario that could cause a monetary crisis due to excessive debt load? And the answer is nobody wants to buy treasuries anymore, and
Yeah.
they have to raise rates dramatically. I'm reminded of the time in Sweden in 1992 when they had their own crisis. They had to raise rates 50 to 500% on a short-term basis in order to keep people from flooding or leaving the Swedish kroner. And the United States, of course, is the world's currency. So there's no place to hide except to go to gold or go to Bitcoin, but probably gold. You notice central banks are buying gold hand over fist. They own more gold now than they do treasuries. Did you know that? So they're planning on trouble that you couldn't get your $17,000 an ounce for gold if you had a treasury collapse and a no bid on treasuries. And I'm not saying that will happen, but I am saying the Treasury may have to raise rates rather dramatically to get people to buy treasuries.
Well,
If
let's say
that is an ultimate danger. We know that's a crisis that's coming at some point. We just don't know when. We kick the can down for year after year, and nobody cares. Trump doesn't care. Congress doesn't care. They just extend the debt. Let the debt keep rising and rising, but you got to pay the interest. And at some point, they may say, hey, well, we'll just print money instead of paying interest on principal and interest on our debt. We'll just start printing money. And that's when you get things out of hand.
Do you think if Japan's yen continues to weaken and depreciate, eventually we could have a reversal of the yen carry trade? Massively unwind, and that may push up interest rates so much that we could have a failed treasury auction here in the U.S.?
Yeah, I think that, you can have these kinds of black swan events, and it can come out of nowhere. And the carry trade with Japan that's been taking advantage of low interest rates in Japan for year after year after year. And now Japan is raising their rates.
Right.
So the carry trade is not working like it used to. And that could cause, you just never know what's going to happen to cause this crisis. I do remember Scott Bessent going into the office a year or so ago when you had the Liberation Day and he imposed all these tariffs, and Bessent went into the White House and said, Mr. President, we're having trouble with the Treasury market. They're not doing well, and this could get out of hand really fast. You need to back off your tariffs, your Liberation Day movement, which he did right away because Wall Street talks. The Treasury, Bessent is the smartest guy in the room these days. And he warned the president, you need to be very careful here. So the president is engaging a lot of excessive spending and warmongering. It's a dangerous environment, and it could backfire at any time.
So finally, you like the tech space right now. There's a saying during a gold rush, buy shovels. So what is the equivalent today for the stock market, particularly the tech sector? What are the shovels, so to speak, for the tech sector?
Well, certainly, I mean, you have many companies that are small companies that provide services, and the supply chain, filling the supply chain for defense spending, like the people that put together the drones and put together the supplies and that sort of thing that are going on these days. I mean, if you look at defense spending, look for the smaller companies that are providing that in defense spending, and also SpaceX. SpaceX is now public. There's lots of rumors that it's going to merge with Tesla to one big, beautiful company that Elon Musk will control. You need all of these different supply chain, smaller companies that are going to produce the electric power, that are going to produce the chips, All of this kind of thing is essential in the marketplace. So I don't have any specific companies to give you in terms of names at this point, but they are definitely the way to go.
Tell us about the actual growth of the economy, the fundamentals driving the stock market boom. GDP is expected to continue growing, but you have another estimate, gross output. Tell us how your estimate differs from the official government GDP numbers.
Yeah, so gross output is a official government statistic. The Bureau of Economic Analysis, the BEA, does cover gross output. They kind of bury it in the data, so not too many people know about it, but it's the top line in national income accounting. We're measuring spending at all stages of production. GDP is the bottom line. It measures only final output. It doesn't include the supply chain. And how important is the supply chain? Sadly, most economists ignore the supply chain, and most media focus just on GDP. That's final output. But what about all the different stages of production that lead up to it? That's a leading indicator. It's called gross output. And for over a year, gross output has been growing at a very slow rate, slower than GDP, almost negative. In fact, it was negative in real terms for almost a year. The good news is in the last quarter, and we only have first quarter data for gross output, it actually grew faster than GDP. The supply chain is finally coming back to life. I think it was really hurt by the tariffs, by the Trump trade war, but it's finally coming back to life. Maybe that's because the Supreme Court has ruled against these tariffs. The president keeps trying to impose them, but so there's some optimism there with gross output, and that's the supply chain, and that's the technologies that are feeding into the final output of these various products. So I'm relatively optimistic, and one reason I'm remaining bullish right now in the technology sector, as long as a black swan event does not occur.
When should we use a measure like gross output, which measures or uses the supply chain and measures spending, versus gross domestic product, which measures final output? In which cases would one be better than another?
So I see them as complementary. They're not replacing each other, but gross output is definitely something that has a bigger picture. And in fact, as Steve Forbes says, GDP is the X-ray, and the gross output is like the I'm trying to think of the term when you go through the MRI and so forth. You get a much bigger picture of the economy because it includes the supply chain. So gross output measures spending at all stages of production. So it's total spending. It's really total spending in the economy. If you really want to measure the total activity in the economy, you want to look at gross output, and it's more than twice the size of GDP. So that's the top line that you should look at. It's just like any financial company. No Wall Street analyst is worth his salt if he doesn't look at the top line sales and the bottom line profits. You got to look at both.
I see.
You can't just look at the bottom line, because you have to look at sales, because sales will tell you if you can keep paying the profit in the future. And as I said, right now, gross output is starting to grow faster than GDP, and this is a very positive sign for the economy growing. And I think a lot of it has to do with the corporate tax cut that Trump pushed through in 2017, lowering the corporate tax rate to 21%. I mean, do you realize corporate earnings are up 40% this year? I mean, that's historic. That's something that Trump can be proud of and be honest about. Most of the time, he's lying through his teeth about how good the economy is. Well, the corporate earnings scene looks really pretty good, and that's one reason it's driving stock prices higher.
Well, Mark, I appreciate your thoughts. That was a very good summary of the current situation. Tell us about where we can find you and read your work. Your book, we mentioned your book. But you also have a newsletter as well. Tell us where.
Yep. It's called the Skousen Report. For 45 years, I wrote forecasts and strategies with Eagle Publishing, and I have made the change to the Oxford Club, which is about 10 times bigger. They're really a dynamic firm. And now I have almost 100,000 subscribers. So it's called the Skousen Report. If you go to oxfordclub.com, you can read all about it. And if you're interested in any of my books, such as The Greatest American by Ben Franklin, or The Maxims of Wall Street, a best-selling book, The Making of Modern Economics, they're listed at skousenbooks.com. And that's where you can purchase my books at a discount. So hope to keep in contact with you in the future, because we need to know the signs of the times. And it's things are looking pretty good right now, but there's always those black swan events in the future that we need to prepare for. And I've made a few calls over the years predicting those black swan events. So we'll see how it goes. Thank you.
Okay, well, please do check out Mark's work and read his book about Benjamin Franklin. I'll put the links down below. Thank you so much, Mark. We'll speak again soon. Take care for now.
All right, David. Thank you. Take care. Bye-bye.
Thank you for watching. Please do like and subscribe.